For some reason, the market can never figure out how to properly judge the results from American Express. I've lost track of the number of times that I've had to come out here and tell you Wall Street's gotten another Amex quarter wrong. Hey, by the way, that includes last time the company reported in July, on the same day as that big CrowdStrike outage. American Express tumbled nearly 3%, and the very next trading day, I told you to buy the dip. It went on to rally from $245 all the way to $286 last Thursday. Buy! Right before the company reported all over again. Unfortunately, I've got to get repetitive here because it happened again. On Friday, American Express delivered another strong quarter, and the market didn't like it, selling the stock down 3.1%. Today, it lost another 2%. So it's now gone from 285 and change to 270 and change. Big hit. But after taking a close look at the quarter, I can tell you that once again, this was actually a great set of numbers. Like clockwork, you need to buy. While American Express reported in-line revenue, their build business, the total spending on their cars, has stabilized at a 6% growth rate. Their total expenses were up 9% year over year, but that was still substantially lower than expected. All told, American Express earned $3.49 per share. The street was looking for $3.30. As for the guidance, management formally trimmed its full-year revenue forecast slightly from 9 to 11%. That's growth, down to just 9% growth. But they also raised their earnings outlook for the second quarter in a row. Last time they were talking about 19 to 23% earnings per share growth. Now it's 23 to 25% growth. That's huge. For the core U.S. consumer business, it looked like the year-over-year growth for each of the company's three demographic buckets. You see far different results. Millennials and Gen Z cardholders are still spending like mad, with build business up 12% year-over-year. Meanwhile, build business for baby boomers and older was flat year-over-year. Gen X is somewhere in the middle with 4% build business growth in the quarter. More on that a little later. Their international card services division is roaring with build business up 13%. I think there's tremendous opportunity there. Finally, American Express had excellent credit quality numbers, and these should only improve now that the Fed has started cutting rates. Normally, at this point in the business cycle, credit quality becomes problematic. Not this time. The total provision for credit losses was a little lower than expected, largely thanks to fewer write-offs. Delinquencies and write-offs as a percent of loans and receivables are both looking good. Well, then why the heck did the stock sell off on Friday? I think Wall Street doesn't know what to do with Amex's gradual slowdown in revenue growth. They had 13% growth in the third quarter of 2023, and it was just 8% this quarter. They've gone from basically the low double digits to the high single digits over the past year. This isn't so much an issue for the company's current results, but it makes some investors question whether American Express can keep hitting its longer-term targets. A lot of people feel they're too aggressive. They're aiming for double-digit revenue growth and mid-teens earnings growth. In fact, the revenue growth slowdown was the first thing the analysts asked about on the conference call. CEO Steve Squeri explained that it will be hard to generate double-digit revenue growth without a pickup in build business, meaning higher transaction volumes. However, he also made it clear that even though the revenue growth has slowed, American Express has still been able to put up better and better earnings growth. That earnings strength is the reason why I pounded the table on Amex when they last reported back in July, and I think it's the big reason why the stock was able to surge to new all-time highs after that initial post-earnings sell-off. But for whatever reason, when we get the actual quarterly results, Wall Street only seems to focus on the top line, not the bottom line. Squeri also made some poorly received comments about organic spending growth, which he conceded is not great right now. Not terrible, but not great. Squeri said, I'm going to quote here, I think when you look at the overall spending, organic spending in our customer base is not as robust as it was in a more robust environment, end quote. He goes on to say, though, what our cardholders will do is pull back slightly if they lose any confidence, see any sorts of signs of their own stress, but they will continue to pay their bills. And that's why our credit numbers are so good. You know what? That's a fairly honest, sober assessment of the state of Amex's business right now. But somehow the company's still been able to post amazing earnings numbers, and the environment should get much easier as the Fed cuts rates. So what are the sellers missing then? I've already said my piece on the earnings story, so let me allow to explain the long-term opportunity here, which is that American Express has the potential to grow with its legions of younger cardholders. Remember, they're seeing terrific spending growth from millennials and Gen Z. Younger cardholders are still spending like mad, while older customers are basically flat. But people seem to overlook the fact that this is a very positive indicator for the company's future. See, once American Express lands these younger customers, there's a very good chance that they'll be able to hold on to them for life. As their cardholders become older and more affluent, they can graduate from a green card to a gold card to a Platinum Card. Hey, by the way, each of these higher tiers comes with not just better benefits, but also higher fees. A Platinum Card costs almost $700 per year. They're the only player in the space that can get away with charging these fees at scale, in part because the Platinum Card has such incredible travel benefits, but also because they got great customer service. Beyond the explicit fee revenue, though, you need to keep in mind that younger customers have a higher lifetime value than a Gen X or a baby boomer customer. As Cramer spelled out explicitly in the call, sometimes, I got to tell you, I mean, the analysts either don't seem to understand this or they don't value it very highly, and I think they're wrong. At the end of the day, American Express reported a strong quarter, and its stock still dropped more. It's now dropped more than 5% over the past 2 sessions in response. And like I tell you, almost every quarter, when the stock sells off like clockwork, I think you're getting a fantastic buying opportunity. Now, the bears are too focused on companies' slower revenue growth, but they're missing the fact that this hasn't prevented American Express from blowing away the earnings estimates. And earnings are the more important metric here. You have to trust me on this, because I've been right, the analysts have been wrong. Bottom line. Don't miss the forest for the trees here. American Express had tremendous success at winning over lots of younger customers who will likely stick with the company for decades to come. And that's the big story here. Not a line or two in the call about softer spending environment right now, which management is handling with aplomb. And if you believe the big story, then like me, you know that this regularly quarterly pullback is your chance to buy American Express hand over fist. That money's back after the break.
Coming up, lightning doesn't just strike twice in Cramerica.
Booyah, Jimmy Chill. Booyah, booyah, booyah.
Thanks for taking my call.
It strikes every day. Cramer is back in a flash with your questions. Next. Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.